Tesla's market cap is now bigger than Volkswagen, Toyota, Nissan, Hyundai, General Motors, Ford, Honda, Fiat Chrysler and Peugeot all combined. And actually their market cap surged more in one day than what General Motors is worth in total. And the result of all this? Well, at one point, Elon Musk passed Jeff Bezos as the richest man in the world, although this did only last for a few days before Bezos went back to number one again. Now, the EV sector is currently booming, and it seems anytime there's a new EV opportunity, the stock just blows up. Will electric vehicle continue to boom, or is it in a stock market bubble and eventually crash? EV boom or bust? Well, since the market crashed in March 2020, Tesla shares have soared 1,100%. That is 12x your money. Now let me actually bring this into context. To make that sort of gain in the normal markets, so 10% return yearly, if you invested £1,000 into the market, after 25 years, you would have got up to £12,000. And that is essentially what Tesla has done. What it would take an investor 25 years to achieve in their portfolio. And it's not just Tesla either. NIO shares have gone up 1,600% over the course of 2020. And XPeng, who went public in August 2020, they've seen a 115% rise in their share price. And even this, at one point, it was up 240%. And it's not just electric vehicle companies either. I mean, the SPAC company Switchback Energy, they gained 330% since they merged just a few months ago with ChargePoint Plus, which is the EV charging company. And QuantumScape, the next-gen EV battery maker, they're up nearly 500%. And this was after a huge sell-off. So it seems that most companies that have something to do with EV are just booming. Now, everyone knows that the time for petrol and diesel cars is coming to an end. EV is the future. There's no real doubt about that anymore. So it's not a matter of if anymore, it is a matter of when. I mean, Boris Johnson has already announced that all petrol and diesel cars will be banned from 2030. The original target was 2040, but they've pushed that forward by 10 years. China have already announced all of their new cars will be EV by 2035, and there's some estimates to say that 90% of all new cars on the market in the US will be electric by 2050 in order to meet climate goals. So naturally, investors are now getting very excited at the prospects of making some huge gains by being exposed to this thriving EV sector. I mean, you might be thinking, should I be buying EV stocks? Should I hold? How long will this sector boom for? And then of course, the big question, are we in a bubble? Well, stick around till the end to find out. Hey, what's up people? Welcome back to our channel, Ralph Finance UK. So let us get straight into it. We know that the EV sector is currently booming. So we'll start off with Tesla. Tesla shares have surged 1,100% over the course of 2020, putting Tesla's market cap at £580 billion, up more than £500 billion just in 2020, and their PE ratio is at around 1700. Now, Tesla's market cap is now bigger than most of the largest automakers in the world put together. So overall, Tesla have been beating their sales targets, they've had their first fully profitable year, they have had breakthroughs in their battery technology as well. The stock split really helped. I mean, it made the stock look really cheap, which had all the investors rushing in, and then the inclusion into the S&P 500 came in at just the right time. And we've seen the effect of this on the share price. It gained 12x in value since March 2020. Now, Michael Burry, the famous investor who the movie The Big Short is based on, he's the one who predicted the 2008 housing market collapse, and he made a lot of money at a time many investors were actually losing money. Now, he more recently, in December 2020, he shorted on Tesla. And that was the day that Tesla's stock price jumped up 8%, adding £43 billion to its market cap, which is more than what General Motors is worth in total. Now, Burry has said that he thinks Tesla's share price is, quote, ridiculous, and he also said, enjoy it while it lasts. Now, there's really two types of Tesla investors. First, we have the retail traders. They're the ones who are caught up in the hype and they think by investing in Tesla, they can get rich pretty quickly. These people, they're not investing into Tesla because they think Tesla as a company will do great. They're simply buying into Tesla to make some quick money. Now, the problem with that is that if the Tesla share price was to drop, then regardless to how the company is performing, because it is a good company, regardless of that, these retail traders, they'll always be pretty quick quick to sell, and this can add quite a bit of volatility to that share price. I mean, we saw the share price fall by around 34% just in the matter of a week in September 2020. So that's the first type of Tesla investor. Now the second type, these are the people who have that long-term positive outlook on Tesla, and they are the ones that are typically looking to hold Tesla shares till maybe at least 2030, regardless to how volatile the price is. And if the price was to say drop by 50% in the next few months, the traders will be selling, whereas the investors will be looking to buy in more shares at a discount. And so it's this ratio of the traders to the investors that is causing that share price to be quite volatile. Now, if we look over to China, they've already announced that by 2025, 20% of all the new cars coming onto the market must be electric vehicles, and by 2035, this should be going up to 100%. So combustion cars will be completely phased out and replaced fully with electric cars. Now, the total electric vehicle sales in China, they are living up to expectations. November 2020's tally surged more than 100% to just under 170,000 EV vehicles. But it wasn't always so positive. Now, because as a result of the huge growth prospects that the investors were initially seeing, the Chinese EV startups initially became a magnet for investors. They were basically just looking for the next Tesla. Now, by 2019, China had 635 EV startups on paper, but only a few of these had actually produced a single car, and most of them did look doomed as many investors lost confidence. And during this time, we saw NIO, the Chinese EV car maker's share price go from £7 straight down to £1, as the investors were basically just fleeing towards the end of 2019. However, since then, we've actually seen some remarkable growth in NIO, because in late 2019, NIO had one advantage that most other startups lacked. It was actually selling cars, and since then NIO shares have rallied. I mean, we've seen a 1,600% gain over the course of 2020, which is a phenomenal level of growth. And looking at their financials, we see that NIO's third quarter revenue was just under £500 million. That is up 150% year on year. And their current quarter revenue has surged to just under £730 million. Now, something that NIO is doing that Tesla isn't doing is battery as a service. Now, all that means is instead of waiting hours to charge up your car, now it's just going to take 3 to 5 minutes to swap a battery out, put a new battery in at a battery swapping station. And NIO users will have to pay a £100 per month subscription charge, and this is a great way for NIO to produce some regular income away from their car sales. And NIO currently has 131 of these battery stations throughout the highways of China. So you can think of it like they manufacture the car and they own the petrol stations to fuel that car in today's world, which would be crazy, but that is what they're doing. Now, although NIO's initial revenue is relatively low, it does seem that over time they could see some solid revenue increases as their battery subscription service becomes more mainstream. NIO also has the advantage that they have the backing of the Chinese government, and in 2020 we saw the Chinese government offer NIO £730 million in funding. Now, another exciting development from NIO is their new innovative 100 kilowatt battery, and as a comparison, the Tesla Model 3 battery is 50 to 75 kilowatts, so the jump up from a 70 to 100 kilowatt battery, it is a big step up. Now, it's not all positive news with these Chinese EV car makers. I mean, we saw Nikola's share price tank 77% to date from the peak in mid-2020. And this happened after they created an advertisement rolling a truck down a hill. Some investors thought it was a working model. Now, Nikola did say themselves that the Model 1 is an incredibly successful proof of concept, even though it was just a truck rolled down a hill. And then at the end of November, we had Hindenburg Research release a report alleging that the Chinese battery and EV manufacturer Candy Technologies Group has allegedly faked over half of its last 12-month sales. And the share price responded accordingly. I mean, they tanked 50% and they haven't recovered since. Now, I just want to take a second to say, if you are finding value out of this video, then do hit that thumbs up button. That way you get more of my videos recommended to you. Now, overall, looking at the bigger picture, most EV stocks are doing pretty well, mainly because investors are looking for the next Tesla, and also because EVs are the hot topic of today. I mean, whenever we've got these exciting new technologies and the companies that create them, they do seem like obvious investment opportunities to most people. Most people say, why would you not want to invest in a company which is leading a new technology? And this is why many people are now pouring their money into these EV stocks. But for us to understand whether this boom in EV stocks is justified and just how long can this go on for, we need to understand what is it that usually happens whenever we see a new technology develop. And you'll find we actually always see the same sort of thing happen. It's actually just a cycle. If we can understand this cycle, we really begin to understand the whole EV boom. So first, the cycle starts when we typically see the need to improve something, and this causes the eruption phase, an eruption in new ideas, new projects. We see many new startups, and a lot of money gets spent on research and development to try to understand how this new technology could be implemented and to actually develop something. This is then followed by 2 or 3 decades of the installation phase, so that's when the new technology is actually installed into the economy, and this can somewhat be divided because you have the people who want to just stick to the old technology because that's what they know, that's what they're comfortable with, and then you have the people who are willing and they're excited to move over to the new technology, so you do get a bit of a divide. Now, this installation phase has historically been accompanied with a major bubble because you have these breakthrough technologies and people think breakthrough technologies equals extraordinary profits. So whenever an exciting new technology company is being tested, there's a lot of potential outcomes. No one fully knows what's going to happen, and it's this uncertainty about the profitability which then leads to higher prices. This uncertainty increases the fundamental value of a company, and so that share price just goes higher and higher and higher. Then we get towards the end of the bubble phase, where the market essentially learns about the actual profitability of these new technology businesses, and that uncertainty about their extraordinary growth rate, that uncertainty reduces. So as the market prices in the actual growth prospects, that uncertainty drops, and then we also see the bubble collapse. The expectations that were way too high at the beginning, they tend to go away, and at some point fundamentals actually become important again, and so the stock becomes more reasonably valued. And then we have the final phase, which consists of more organic and more justified growth, and this essentially lasts until this technology becomes outdated, and then we arrive at the next eruption phase and the whole cycle starts again. So the concept is that investors essentially become irrational about the potential for high profits from the new technology. The prices then shoot up way above the fair value, and then as the uncertainty in the potential for the new technology drops, the prices also drop. Now, we have seen this cycle happen over and over. I mean, we saw this surge of development in canal mania, which was followed by a canal bust. Railway mania was followed by a railway bust. Bicycle mania was also followed by a bust. The roaring 20s ended with the Great Depression, and the surge of IPOs in the internet bubble ended with the tech crash. So based on all of this, we could see the very same thing happen to the EV market. Now, of course, EV has a lot of value for the future, but I think we're still very early in this cycle. There's still a lot of uncertainty on just how profitable this market really is. And it's because of this uncertainty that people have just been buying these stocks for the sake of buying them without doing any sort of fundamental research on them, which has led to the prices just shooting up. Now, the problem with this is that anytime there's a little bit of panic or concern that comes up in the markets, you end up seeing these stocks sell off. And the main issue is that even if everyone believes in these EV companies and it's not a bubble, how do you still put a value on it? I mean, what is the fair price of Tesla? Who knows? And because there's no real way to put a true value to these EV companies, it could lead to the formation of a bubble regardless to whether people believe in EV as the future or not. And this is perhaps why Tesla's market cap is now bigger than Volkswagen, Toyota, Nissan, Hyundai, General Motors, Ford, Honda, Fiat Chrysler and Peugeot all combined. I mean, you can't just view Tesla as a car manufacturer, and because of that, it is very difficult to put a price on it, and this is what can distort that share price. I mean, we had the dot-com bubble where it was pretty much the exact same situation. People knew the internet was the future, and it was. I mean, the internet is widely adopted throughout the world, yet they still didn't know how to actually put a value on all of these tech companies, and So all they could really do is pour their money into these companies purely based on these huge growth prospects. And so the prices soared really high before coming crashing down. But then what you find is that over time, over the long term, slowly and slowly, people have learnt how to value these companies. And so the prices of these tech companies have been increasing over the long term. I mean, if we look at Amazon, it was around £73 per share back in 1999, before dropping to around £5 just after the crash. And it wasn't until 2009 that the share price went past £73 again. So it took 10 years to surpass its historic high. So you need to understand that no matter how much confidence there is in EV for the future, even then we may still see a bubble form. Prices may get inflated, crash down, and then increase more gently over the long term. So from an investor's point of view, in order to limit their risk, what they can do is diversify. So instead of just picking one or two EV companies, instead, if you believe in the EV sector, you can invest in a fund of EV companies where you can get involved and participate in the upside, but it also helps you to reduce your risk if one of the companies goes down. It all depends on your risk appetite. If you're looking purely for some huge gains and you are willing to accept a higher level of risk, then you may just want to invest in these individual companies. But if you want to limit your risk, then you can spread your investments across many different EV companies. But of course, then the upside will be limited because you're not as exposed to the huge growth that a single company could see. Now, for most investors, it will be a combination of funds and individual companies. Now, an example of an EV investment fund is the iShares Electric Vehicle and Driving Technology ETF. This has symbol ECAR. Now, some of the largest holdings in this are Tesla, BYD, Samsung, Fiat Chrysler Group, and Hyundai. And in total, there's 81 holdings, so it is pretty diverse. Now, it's really important you don't confuse good companies to good investments. These are two very different things. A great company could be significantly overvalued because everyone believes it's a great company, and therefore it could be a poor investment, whereas a terrible company could be a great investment if it is significantly undervalued. So don't confuse companies with their stock prices. They should definitely be viewed separately. Overall, we currently have a lot of stocks that everyone thinks are the next Teslas because everyone keeps comparing Tesla to NIO, Tesla to XPeng, and many other companies. And usually this sort of speculation is met with some sort of big sell-off. Either way though, there is no doubt there is a lot of money to be made from investing in EV companies. The example I gave right at the start of this video was that by investing into Tesla at the start of 2020, you'd do better in 1 year than someone who achieved 10% return every year for 25 years. So the big question is, will EV stocks continue to boom and be volatile, or will we see a correction and then the constant long-term growth? Let me know what you think will happen to EV over the next year and whether you think we are in a bubble or not. And if you found value out of this video, hit that thumbs up button. You get more of my videos recommended to you. If you subscribe as well, you won't miss our next video. I hope to see you on the next one. Take care.